Are you a real estate investor who's been convinced that cash flow is king? Well, maybe it's not. Today on Realpreneur Principles, we're going to explore the possibility that cash flow might be all that it's set out to be. I'm Nikolai Ray, and I'm the CEO of the MREX, and this is Realpreneur Principles. As I said in the introduction earlier, for years, gurus in real estate, whether it be in conferences and books, have been talking about the importance of cash flow. And it's gone as far as there are books that are written entirely on cash flow, including the Cash Flow Quadrant, and there are even board games on cash flow. Now, the point of the video today is not to say that cash flow is not important or that you should not be focusing on cash flow, but ultimately, what one must ask themselves is cash flow really king? And my view on it is that cash flow is king, but with a caveat. And the caveat is that cash flow is king if net worth is queen. So what I mean by that is that if cash flow is to be king, and if cash flow is to be of such a prime importance for a real estate investor, specifically in multifamily, it's important that net worth is sitting beside that cash flow, because ultimately cash flow is a function of net worth. It's a pretty simple calculation. If you don't have any net worth, it's almost impossible to generate any cash flow, because usually if you're buying an apartment building, cash flow is a function of net worth. So let's say you have an apartment building that generates, most apartment buildings will generate on average around 5% cash on cash, meaning that if you invested $100,000 into the property through equity or your down payment, in other words, well, you should be generating a free cash flow of $5,000 a year, which is 5%. The problem is that if you don't have any net worth, or you're not putting any equity into the deal because you're using various ingenious techniques to reduce your down payment, it's very hard to generate that same 5% cash on cash, or it's going to be 5% on something much lower. So it's important to understand that instead of focusing initially on cash flow, and this is especially for you investors who are at the beginning of your careers, it's important to focus on growing your net worth, on growing the total value of the equity that you have and that's invested in properties. And then once that's done, you can focus on cash flow. Because the second point of this video today is to understand that cash flow is also kind of like savings and investments. So the more cash flow that you take on a property or the market that you go to that generates more cash flow actually will not allow you to grow your net worth as much, and will not allow you to grow your future cash flows either. It's the concept of instant gratification. So kind of like when we teach children or when we teach basic finance, it's easy to understand that for every dollar that you spend that you don't invest, well, that's ultimately preventing you from growing your net worth and from getting richer and getting more cash flow later on. Same thing with cash flow in apartment buildings. The more the cash flow that you take on early, in the early stages of your acquisitions or of your career, well, the less future cash flow growth you'll have and the less net value growth you'll have. And if cash flow is a function of net value, well, obviously it's easy to understand how that lack of delayed gratification, because for various reasons you might want to leave your W-2 job, you might want to be a full-time real estate investor. Well, what I'm saying is that cash flow is probably not the holy grail for you at this stage in your real estate investment career. The third point is that cash flow is also a function of risk. So a basic finance principle is that $1 today is worth more for you than $1 tomorrow. Now, why is it that certain markets or properties cash flow more? Is because these are riskier properties or markets, and these are properties and markets where there's probably less potential growth appreciation, and also or more risk with regards to the probability of collecting the rents or the NOI as predicted. So these become riskier investments, riskier properties, or riskier markets. Thus, the property is actually generating a higher percentage of the overall return in a form of cash flow. So the example to understand this is actually quite simple. Let's say that you have two properties that generate 12% of internal rate of return, so overall return, but possibly one property will actually be generating 6% of cash on cash, while the other one might only generate 3% of cash on cash. Well, there's probably a good reason behind that, and that is that the one generating the 6% cash on cash is probably a much harder property to manage with more difficult tenants in place and thus much more risk with regards to those returns and revenues. So it's important to remember that cash flow is not just something that we look at in a vacuum, and you can't just throw things out there like cash is king and it's the gold standard. And it's easy to say these things, but ultimately real estate investing is a very complex and complicated affair, especially in multifamily real estate, and even more so now that the real estate investment game is becoming more and more sophisticated thanks to the internet, various tools and technology and data, and also because, well, let's face it, a lot of money, a lot of white powder is coming and has been coming into real estate and will continue to come into real estate. Therefore, you as a multifamily real estate investor, whether you be at the beginning of your career, just about to purchase your first property or first couple properties, or even if you are more at the spectrum of small cap to mid-market, meaning you own between, I don't know, between 30 to 50 or even up to a couple hundred units, it's important to understand all the moving parts and levers of what it is you are investing in. So it's important to remember that cash flow is like the fruits of your labor. You have to plant the seeds and let the trees grow before you start collecting the fruits and picking them out of the trees. Yes, cash flow is king, but only when equity and net worth is queen.